to the Money RX for CRNAs podcast, where you go behind the scenes with host Brett Fellows, CFP, as he explores the unique opportunities and challenges facing certified registered nurse anesthetists along the path to financial independence. In each episode, Brett shares expert insights and actionable advice, equipping you with the tools you need to take control of your financial destiny and retire on your terms. And now, here's your host, Brett Fellows.
Welcome to the Money RX for CRNAs podcast. Thanks for joining us. I'm your host, Brett Fellows, a certified financial planner with over 20 years of experience in guiding CRNAs through the complexities of financial planning, tax strategies, and investment management. For those of you who have tuned in before, welcome back. And for anyone who is listening for the first time, this podcast is dedicated to helping certified registered nurse anesthetists achieve financial independence and ultimately retire on their own terms. On today's Money RX for CRNAs episode, we're going to talk about different strategies to maximize your tax deductions, the benefits of each, and what should be considered when choosing the right strategy for your financial plan. As always, thanks for joining us. Our primary audience is CRNAs around the age of 50, often married with children, and typically about 10 years away from retirement. You've worked hard, and now it's time to ensure that your money works hard for you. If you want to receive weekly updates with recaps of the show and other resources that we mention on the show, as well as some exclusive content, sign up for our Friday Blitz email, and you can do that at oakcapitaladvisor.com. That way, once a week, you'll get an email with a recap of everything and some links to the stuff that we talk about in each episode. And with that out of the way, let's get started on your journey to making work optional on your own terms and get you some tips for maximizing tax deductions this year. Nothing is certain except death and taxes. Benjamin Franklin's observation still resonates today, especially around April 15th. Now, for many of us, this time of year brings a mixture of anxiety and curiosity. Will we owe the government more, or will we receive a refund? The good news is that it doesn't have to be this uncertain. There are many legal ways to save on taxes, but it requires proactive planning, not just hoping for the best when you file. The very first thing to remember is that tax planning isn't just about preparing for April 15th. It's about having a year-round strategy that works alongside your financial goals. And while you might work with a CPA, it's essential to know that not all CPAs are trained in tax strategies. Many are focused on tax compliance, which means filing your taxes accurately. However, comprehensive tax strategies that minimize what you owe are often more in the domain of financial planners who focus on big picture wealth management. So make sure that you have the right experts on your side to help you navigate these complex waters. Let's begin by discussing tax loss harvesting. Now, this is a strategy that can offer significant benefits for CRNA investors. The strategy involves selling investments at a loss to offset gains from other investments. The goal here is to reduce the taxes you owe on capital gains, which can help you keep more of what you earned. It's an especially useful tool for managing short-term capital gains, which are taxed at a higher rate than long-term capital gains. But a huge word of caution: you should never sell an investment solely for tax purposes. If you sell at a loss, make sure it aligns with your overall financial plan. And this is why it's so important to think holistically about your investments and tax strategy. Tax loss harvesting isn't a one-size-fits-all solution, and while it can be effective, it needs to be implemented thoughtfully. And if you're unsure whether it's right for you, I highly recommend discussing this with your financial advisor to ensure that it fits your long-term goals. And for those of you maybe more interested in reading about tax-efficient harvesting or tax-efficient investing, the Bogglehead's Guide to Retirement Planning is an excellent resource. It offers a deeper understanding of how strategies like tax loss harvesting fit into a broader retirement plan. And we'll put a link to that book in the show notes. Now, let's talk about IRAs, or individual retirement arrangements. I know that sounds funny. Most people refer to them as individual retirement accounts. And for good reason. They're one of the most popular tools for building retirement savings. But the real power of IRAs is in their tax advantages, and which IRA you choose, traditional or Roth, can significantly impact your financial future. With a traditional IRA, contributions may be tax deductible, which means you could see immediate tax benefits for the year you contribute. Plus, the money you invest grows tax deferred, meaning you don't pay taxes on your gains until you withdraw the funds in retirement. Now, this can be a great way to lower your taxable income now and save for the future at the same time. On the other hand, a Roth IRA works a little differently. With a Roth, contributions are made with after-tax dollars, meaning you don't get an immediate tax deduction. However, the significant benefit comes later. Your withdrawals in retirement, both your contributions and any investment gains, are tax-free. So if you expect to be in a higher tax bracket in retirement, or if you're looking for flexibility in how you manage taxes down the road, a Roth IRA can be a hugely powerful tool. So the decision between traditional and Roth IRAs depends on your current financial situation and what you expect in the future. Next, we have 401k plans or 403b plans, which are another cornerstone of retirement planning. If you have access to a 401k or a 403b through your employer, contributing to it is one of the easiest ways to save for the future, and it can offer substantial tax benefits. With traditional 401k and 403b plans, contributions are made pre-tax, which again reduces your taxable income for the year and allows your investments to grow tax-deferred. That means you'll pay taxes when you withdraw the funds in retirement. And if your employer offers a match, I highly recommend taking full advantage of it. That's free money that goes straight towards your retirement savings, and it can make a significant difference over time. Because every dollar you contribute now grows through the power of compounding. So the earlier and more you contribute, the better off you'll be in the future. Roth 401k and 403b plans, which are becoming more common, allow you to make contributions with after-tax dollars, similar to a Roth IRA. And while you don't get an immediate tax benefit, again, your withdrawals in retirement are tax-free, which can be particularly beneficial, again, if you expect to be in a higher tax bracket later in life. And if you want to know more about this topic, we covered the differences between traditional and Roth accounts in episode number 3, How to Reduce Taxes in Retirement. So make sure to check that out if you want a more detailed breakdown. Another powerful tool that often gets overlooked in tax discussions is the Health Savings Account, or HSA. If you're covered by a high-deductible health plan, an HSA can serve as both a tax savings tool and a way to prepare for future healthcare costs. Now here's the best part. The contributions you make to an HSA are tax deductible. The money in the account grows tax-free, and the withdrawals for qualified medical expenses are also tax-free. That's a triple tax advantage. And even better, HSAs don't have to be used strictly for current medical expenses. They can grow into a retirement asset. After the age of 65, you can use your HSA funds for non-medical expenses without penalty, although you would have to pay income tax on those withdrawals. It's a smart way to plan for both your healthcare needs and your long-term financial future. If you have children or plan to support family members in their education, a 529 plan is one of the best tools to save for those expenses while also receiving some tax benefits. With a 529 plan, your investments grow tax-free and withdrawals used for qualified education expenses like tuition, books, and even room and board are tax-free as well. Additionally, many states offer tax deductions or credits for contributions to a 529 plan, making this a really attractive option for those looking to save on taxes while also investing in their family's future. Many of us are passionate about giving back to causes we care about, and charitable contributions can also help reduce your tax bill. By donating to qualified charities, you may be able to deduct those contributions from your taxable income. Donating appreciated assets like stocks or mutual funds instead of cash can allow you to avoid paying capital gains tax on the appreciation while still deducting the full value of the donation. You can also set up what's known as a donor advised fund as another option for those who want to make a larger impact and take advantage of tax benefits over time. Those CRNAs who exceed the income limits for contributing to a Roth IRA, the backdoor Roth IRA offers a way to still take advantage of the tax benefits of a Roth account. So this strategy involves contributing to a traditional IRA and then converting those contributions to a Roth IRA. While it is a bit more complex, it allows high earners to benefit from tax-free growth and withdrawals in retirement without being subject to income limitations. And as you approach retirement, it's important to think about how you'll withdraw your money in a tax-efficient way. The order in which you draw from taxable accounts, tax-deferred accounts, and tax-free accounts can have a significant impact on how much tax you pay over the course of your retirement. But by strategically planning your withdrawals, whether that means taking from taxable accounts first or making partial Roth conversions, you can minimize your tax liability and make your savings last longer. Estate planning is an essential part of managing your wealth and ensuring that your loved ones are taken care of after you're gone. By creating a plan that addresses both your financial goals and tax obligations, you can reduce the tax burden on your heirs and ensure that your assets are distributed according to your wishes. And for those with significant assets, federal estate taxes and state inheritance taxes may also apply. So working with an estate planning attorney can help you ensure that you minimize these taxes and protect your family's future at the same time. So as you can see, there are many strategies available to help you reduce your tax burden and increase your financial security. Now, if you're feeling overwhelmed by all of these tax savings options, don't worry, help is out there. For those who want a more in-depth, actionable advice, the book Tax-Free Wealth by Tom Wheelwright offers a great resource on understanding the tax code and using it to your advantage. Wheelwright, who's a CPA, breaks down how tax strategies can help you create wealth by keeping more of what you earn. And we'll put a link to that book in the show notes as well. So no matter what stage of life you're in, it's crucial to develop a tax strategy that aligns with your financial goals. So the key takeaway: don't leave money on the table by ignoring tax-saving opportunities. And remember, tax planning isn't just a once-a-year event. It's a year-round effort that should evolve as your financial situation does. So whether you're looking at your portfolio or choosing the best path forward, the right tax strategy can help you grow your wealth and secure your financial future. All right, let's dive into week 3 of Anesthesia Anecdotes, where I talk about some tips about how to be happy that I'm actually trying to do for myself that will hopefully resonate with you on a personal level. Because I know thinking about money and retirement can be a pretty heavy and stressful topic. And how we are with money really depends on much more on how we behave than what we know. So one other thing I've been working on personally is managing my stress and finding more balance, which has made me turn to mindfulness. Now, it's easy to say I need to manage my stress better, but putting that into action is a completely other story. And what's really helped me is using an app called Headspace. It's a meditation and mindfulness app that offers guided meditations, sleep aids, and even short, quick exercises to help you reset during the day. For someone like me, always juggling so many things, it's really been a game changer. I've started using it just for about 5 to 10 minutes in the morning before I dive into work. It helps me clear my head, focus, and approach on my day with a calmer mindset. I think it's a small commitment of time, but it's had a huge impact on how I handle not just my work, but life's little stresses in general. And I know apps aren't for everyone, but finding a system that works for you, whether it's meditation or journaling, or even just scheduling regular breaks during the day, can make a huge difference. And if meditation isn't your thing, maybe try reading Atomic Habits by James Clear, and I'll put a link to the book in the show notes. It's one of my favorite books that focuses on building better habits and how even small changes can make a massive difference over time. One of the things I love about it is how it emphasizes the idea that our habits shape our outcomes, not just in our personal lives, but in our financial lives too. And it's really helped me rethink how I approach both money and my daily routines, and I think you might find it just as useful for you. Well, thank you for taking the time to learn more about financial planning with us today on Money RX for CRNAs. If you know a CRNA who needs financial planning guidance and think that this podcast would help them, click the share button and send it to them directly. Also, to make sure that you continue to receive our content, make sure you click the subscribe button below. And if you or a loved one needs some help or guidance with regards to your knowing how much you need to save for retirement, or if you're simply interested in learning more about my practice, please reach out at any time. You can email me directly at Brett with 2 T's at oakcapitaladvisor.com, or by visiting my website, oakcapitaladvisor.com, and scheduling a complimentary pre-op assessment where I can answer for you 3 of life's most important money questions. 1, are you on track to reach your long-term goals, meaning retirement or work optional? 2, how can your tax bill be reduced? And 3, how can your investments be improved? And until next time, have a great day.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.